let's now talk to Sally Mitchell, who's a mortgage advisor at The Mortgage Mum. Good morning, Sally.
Morning.
So, thanks ever so much for joining me this morning. So, I was trying to put Justin on the spot there about interest rates, and obviously we have seen a reduction. The MPC, as I was saying, it was quite divided this time because some of the members wanted to have a bigger rate cut, some of them wanted to stay where we were. We now believe more interest rate cuts are coming. The big question for people is many people are coming to the end of a fixed rate mortgage. I ended mine, almost a year ago, and I got hammered by my mortgage doubling, basically, which was not ideal. Let's just say it wasn't ideal. What is your advice to people now watching what's going on, maybe people who aren't terribly financial literate but want the best deal?
Yeah, it's a really hard market to navigate because it is so volatile. We thought it would settle, a year ago. We've had another year of just up and down and swap rates going all over the place, announcements, warnings, promises, and it just hasn't happened. We're now starting to get those base rate cuts, which is fantastic if you're on a tracker because immediately your monthly payment will change. And if you happen to be one of the 700,000 people who are on standard variable rates, you should see a reduction coming through, although it's not obligatory for the lenders to pass that on. It's the people on the fixed rates, and there are so many people coming off those historically low ones, and maybe they've been on them for 4 or 5 years. They're coming to the end, and as you said, it happened to you. I see an average of for £400 or £500 increase per month, which is just scary. And of course, in those 5 years, your life might have changed. Your job might have changed. You might have been going part-time because of maternity or paternity leave. So it's not just the extra money, it's actually, are you in a position to find that extra money? And it's causing an awful lot of stress for people, which is very, very sad. I'm glad that the decision went this way because it feels that the Bank of England is actually looking at the economy and supporting the economy instead of just concentrating on inflation. Now, I know that's their job, but it's nice to see that they, I think, are trying to boost the economy. They've slashed the target from 1.5 to 0.75% in growth. Yeah. That's not great. They've got to do something to increase confidence, development, investment, consumer spending. And then I hope that the swap rates will calm down because that's what drives fixed interest rates. So these reductions in the base rate don't necessarily filter through to your average fixed rate mortgage product. But if the swap rates can settle and start to come down and continue to come down, then we should see that filtering through.
Can you just explain to people in a sentence what a swap rate is?
It's basically what an institution will pay to a bigger institution to borrow money. Right. And then they lend that money to us.
Right, I'm with you. And so it's quite interesting. You reiterated what Justin said about there is definitely a change in tone from the Bank of England because they are saying that the inflation is going to settle at some point. We're not going to this is what I'm reading into it. They're not going to micromanage it. And actually, Justin's point, I think, is valid, which is if you cut interest rates, then people have more free money and therefore can go out and spend it. And therefore, you grow the economy.
Exactly. It does seem fairly basic and simple, doesn't it? I mean, I know I'm totally oversimplifying, and Justin's in a much, obviously, better position to comment than me. But inflation, interestingly, is targeted to go up to 3.7% this summer because of energy costs rising again. So, what are they going to do? Are we going to hold at 4.5 and then wait to see what happens? Will there be one further cut in May before the summer increase? It's a real balancing act. To be honest, I'm glad it's not me sitting there.
Well, I was reading yesterday that maybe there won't be a cut at the next meeting, but then there will be 2 further cuts after that. As you say, literally no one has a clue. So, what do you say? I mean, I'm not putting you on the spot here, but obviously, caveat emptor, buyer beware. In terms of coming off a fixed rate, given what we're seeing and the sort of weather patterns of what is happening and the seasonal change here, do people go onto a tracker? Do they fix? I suppose it depends also how much security they want.
Yeah, it really is as individual as you are. Trackers are great if you don't want to be tied into a contract. A fixed rate is a contract. If you want to exit early, then you pay early repayment charges, ERCs, penalties.
And they can be enormous, can't they?
They can be enormous. And the more you borrow, it's a percentage, the higher they are. They could be, £8,000 to £10,000.
Whoa.
So any gain that you think you might get by being on a tracker because you're going to play the market, which is, I think, a dangerous thing to do when it's your home. I don't think people should do that necessarily. Leave that to the professionals. By fixing into a fixed rate, if you're going to want to leave it, then you could end up losing that gain by having the lower rate, if you see what I mean.
Yeah.
And trackers obviously are going to come down, so they're closer, but they're still higher than a fix. The average tracker for a 75% loan to value at the moment is, I think, about 4.7, 4.8. But you can get a fixed 2-year rate at the same loan to value for quite a few, not percentage points, but bips below that. So you've got to work it out. You need to go to a broker and find out what the ERC implication could be. I would say to people who are coming to the end of their fixed product to get their ducks in a row and speak to someone sooner rather than later, 6 months before. I've had clients who, because of the declining base rate, have thought if they have got any savings, actually, you know what, I'm going to overpay my mortgage and try and bring the balance down so that when I remortgage, it's not quite such a hit.
Yeah.
That can work. You can normally overpay by 10% in a calendar year. And also, the good news, not for people trying to get on the ladder, but the good news, Halifax announced their price index yesterday, and the average price of a house has increased. It has gone up. It's now 299 across the country. So when you come to look at your fixed product, check the valuation that your lender is giving you on your property.
Because it's done on loan to value.
Yes. Yeah. So it might be that although, yes, it's going to go up, you've dropped down a layer in their pricing, and now actually you can get a rate at 4.2 instead of 4.8. So double check that. But you're a good broker will be able to do that for you.
Excellent advice. Thank you ever so much. Really, really good to talk to you, Sally. Have a great day. Sally Mitchell, their mortgage advisor at the Mortgage Mama. Before her, it was Justin Urquhart-Stewart, who is an economist. Hopefully that was very useful for you if you are looking to remortgage. But as Sally said, please get advice. Don't just do it on your own. The markets are incredibly volatile at the moment.